Shanghai just hit $87 per ounce. Not next week, not next month. Today, right now, while you were sleeping, while most of the Western world was distracted, the silver market in China exploded past every resistance level, past every projection, past every point where rational market forces should have triggered profit-taking and caused a pullback. But there was no pullback. There was only acceleration. The panic buying that was building quietly in the background, the institutional accumulation that was being masked by careful positioning and quiet execution, has gone completely vertical. And this is not retail panic. This is not individual investors making emotional decisions. This is central banks, sovereign wealth funds, industrial conglomerates, and government procurement agencies scrambling to secure physical metal at any price before the door closes completely. The number itself, $87, is shocking enough. But the number is not the story. The story is the gap. The story is the disconnect. The story is that while Shanghai trades at $87 per ounce, the paper market in New York, the COMEX futures exchange that has dictated global silver pricing for 50 years, is still showing $75. That is a $12 spread. $12. In a market where traders fight over pennies, where algorithms compete for fractions of a cent, where high-frequency systems are designed to capture microseconds of advantage, a $12 gap is not an anomaly. It is not a temporary dislocation. It is not a technical glitch. It is a declaration. It is the market screaming that the emperor has no clothes, that the paper pricing system is broken, that physical and paper have fully decoupled, and that anyone still believing the COMEX price represents reality is living in a fantasy. For decades, the argument has been made that paper and physical are the same, that a futures contract is as good as a bar in a vault, that cash settlement is equivalent to physical delivery, that the global market is efficient and arbitrage keeps everything in line. But $12, Stordersmat destroys that argument completely. If arbitrage worked, if the markets were actually connected, if physical metal could freely flow from west to east to close the gap, then this spread would not exist for 12 seconds, let alone 12 days. The fact that it persists, the fact that it widens daily, proves that the metal in the West is not available. It is not liquid. It is not real in any meaningful sense. It is a ledger entry. It is a promise. It is a claim on metal that does not exist in sufficient quantity to satisfy the claims against it. The panic buying that is driving Shanghai to 87 is not speculative. It is not driven by traders trying to flip contracts for profit. It is driven by entities that need physical silver to operate. Chinese solar manufacturers who cannot pause production lines. Electronics companies who cannot substitute another material. Military contractors who cannot compromise on specifications. Government agencies who have been told to secure strategic materials at any cost. These buyers do not care about the COMEX price. They do not care about technical analysis or resistance levels or what some analyst in New York thinks fair value should be. They care about one thing. Can you deliver physical bars to our facility within 30 days? If the answer is yes, they will pay 87. If the answer is no, they will pay 90. And if you tell them the COMEX says silver is worth 75, they will laugh and move to the next seller. This is what capitulation looks like on the demand side. When buyers stop negotiating, when buyers stop waiting for dips, when buyers start competing with each other, not on price, but on certainty of delivery. This is the phase that precedes vertical price moves. This is the phase where markets stop being markets and start being scrambles. And the data confirms this is already happening. Reports are surfacing of Chinese state-owned enterprises offering significant premiums above spot for guaranteed delivery. Reports of silver bars being flown on chartered aircraft from London to Shanghai because sea freight takes too long. Reports of refiners in Switzerland working triple shifts to meet Asian demand. Reports of vaults in Singapore running out of available space because metal is flowing in faster than it is flowing out. These are not normal market conditions. These are not the symptoms of healthy price discovery. These are the symptoms of a supply crisis meeting unlimited demand. The question everyone should be asking is why now? Why did Shanghai go vertical this week and not last month or next month? The answer is that multiple triggers converge simultaneously. First, the Chinese export ban on critical minerals that went into effect January 1st is now being enforced with real consequences. Shipments that used to leave China freely are now being stopped at customs. Buyers who assumed they could source material from China are now discovering their supply lines are cut. This is forcing them to source from other regions at higher prices or to bid aggressively for existing stockpiles. Second, the Chinese New Year is approaching. Factories that will shut down for 2 weeks are trying to secure inventory before the holiday. This seasonal demand spike is colliding with structural shortage and creating a bidding war. Third, rumors are circulating that the Chinese government is preparing to announce official silver reserve accumulation. If true, this would put the full weight of the Chinese state behind silver buying, and it would signal to every other nation that silver is now officially a strategic asset worth hoarding. Fourth, and perhaps most importantly, the physical shortage in the West is becoming impossible to hide. Inventory levels in COMEX registered vaults have declined to multi-year lows. The amount of silver available for immediate delivery has dropped below critical thresholds, and participants in the London market are reporting difficulty sourcing large quantities. When the West runs low on physical at the exact moment the East is buying aggressively, price gaps become inevitable. The metal flows to whoever is willing to pay the most, and whoever can guarantee they will not rehypothecate or encumber the bars. Right now, that buyer is in Shanghai, and they are setting the price. The panic is not limited to industrial buyers. Central banks are also involved. For years, central banks focused on gold. Silver was considered too industrial, too volatile, too unglamorous for official reserves. But that calculus is changing. Multiple sources are reporting that central banks in the Middle East and Asia are quietly accumulating silver, not through public announcements, not through transparent reporting, but through private deals with refiners and miners. They are securing offtake agreements. They are financing new production in exchange for guaranteed delivery. They are effectively locking up future supply before it even comes out of the ground. This is the behavior of entities that believe silver will become unobtainable at any reasonable price in the near future. Let's discuss what a $12 gap actually means in practical terms. If you are a large trader with access to both markets, this should be free money. You should be able to buy silver in New York for $75, sell it in Shanghai for $87, and pocket a risk-free $12 profit per ounce. This is textbook arbitrage. This is how markets are supposed to self-correct. But the arbitrage is not happening. Why? Because executing the arbitrage requires physical delivery. You cannot simply buy a paper contract in New York and sell a paper contract in Shanghai and claim the spread. You have to take actual delivery of metal from a COMEX vault, arrange international shipping, clear customs, and deliver physical bars to a Shanghai vault. And at every step of that process, you will encounter obstacles. The first obstacle is that taking delivery from COMEX is not as simple as it sounds. You must have an account with a clearing member. You must post significant margin. You must be approved for delivery. And even if you meet all those requirements, the vault may not have the specific bars you need. They may have bars that are encumbered. They may have bars that are already promised to someone else. They may have bars that do not meet Shanghai specifications. The second obstacle is shipping. Physical silver is heavy. It is valuable. It requires secure transport. It requires insurance. It requires customs clearance in both the exporting and importing country. This takes time, and during that time, the price can move. If the spread narrows while your metal is in transit, your arbitrage profit disappears. If the spread widens, you have opportunity cost because your capital is tied up in bars sitting on a ship. The third obstacle is that China has capital controls. Moving large amounts of money into China is not simple. Converting dollars to yuan involves regulatory approval. And even if you successfully deliver the silver and sell it in Shanghai, getting your profit back out of China in dollars is another challenge. These frictions, these obstacles, these risks are why the arbitrage is not closing the gap. The gap exists because the markets are not actually connected by physical flow anymore. They are separated by walls, regulatory walls, logistical walls, trust walls. The West is trading paper. The East is trading physical, and the two markets are diverging. Now let's talk about what happens next. Because 87 is not the top. 87 is not the capitulation price where buyers suddenly decide they have enough silver and stop bidding. 87 is just the current clearing price in a market where supply is fixed and demand is accelerating. If industrial demand remains strong, if government buying continues, if central banks enter the market in size, if the export ban remains in place, if Western vaults cannot deliver metal to close the gap, then the only direction for price is higher. The mathematics are simple. When demand exceeds supply and supply cannot increase quickly, price must rise until demand is rationed. And demand is rationed when buyers can no longer afford to pay, or when they find substitutes, or when they simply cannot obtain metal regardless of price. For industrial users, substitution is difficult. Silver has unique properties. It is the best conductor of electricity. It is the best conductor of heat. It kills bacteria. It reflects light. For many applications, there is no substitute that performs as well. For solar panels, you can reduce the amount of silver per panel, but you cannot eliminate it completely without sacrificing efficiency. For electronics, you can redesign circuits, but that takes time and money. For medical devices, you can use alternatives, but they may not meet regulatory standards. The point is that industrial demand is relatively inelastic. It does not drop significantly just because price increases. Companies will pay more rather than stop production. For investment buyers, the psychology is different. Higher prices actually attract more buyers rather than fewer. This is the opposite of normal goods. When silver goes from 60 to 70, investors fear missing out and rush in. When it goes from 70 to 80, the fear of missing out intensifies. And when it goes from 80 to 87 in a matter of days, the perception shifts from silver is expensive, but to silver is running away, and I need to own it now before I'm priced out forever. This creates a feedback loop. Rising prices attract buyers. More buyers push prices higher. Higher prices attract even more buyers. This loop continues until something breaks the cycle. Usually what breaks the cycle is a massive increase in supply, or a demand shock, or policy intervention, but none of those are visible on the horizon right now. Supply cannot increase quickly. Mining is a multi-year process. Building a new mine takes 5 to 10 years. Expanding an existing mine takes 2 to 3 years. Silver is often a byproduct of other metals, so increasing silver production requires mining more lead, or zinc, or copper, which depends on demand for those metals. Recycling can increase somewhat, but recycled silver is mostly from industrial waste and old electronics, and there's a limit to how much can be recovered. There is no secret stockpile that can be released to flood the market. Governments sold most of their silver decades ago. The strategic stockpile in the United States is essentially zero. China holds silver, but they are clearly not selling it, they are buying. So where does new supply come from? It doesn't. Supply is relatively fixed for the next several years. Demand shock could occur if the global economy crashes and industrial production collapses. But even in a recession, green energy transition continues. Solar installations continue. Electric vehicle production continues. These are policy-driven, not purely economic. Even if consumer demand weakens, government mandates ensure that industrial silver demand remains strong. And if the economy crashes, that typically drives investment demand for safe haven assets, which would increase demand for silver as a store of value. So a recession might not reduce total silver demand at all. It might just shift the composition from industrial to investment. Policy intervention is the wild card. Governments could do several things. They could ban exports of silver, which would trap metal in producing countries and potentially lower domestic prices while raising international prices. They could release strategic reserves, but as already mentioned, those reserves are mostly depleted. They could change futures market rules to force cash settlement and prevent delivery, which would destroy confidence in paper markets, but would not create new physical supply. They could impose price controls, which would create black markets and shortages. None of these interventions would actually solve the underlying problem, which is that physical supply is insufficient to meet physical demand at the current price. They would only create distortions and unintended consequences. So if supply cannot increase quickly, if demand remains strong, and if intervention is unlikely or ineffective, then the logical conclusion is that price must continue rising until equilibrium is reached at a much higher level. Where is that level? Nobody knows for certain. But we can look at historical precedents. In 1980, silver briefly touched $50 per ounce, which is roughly $150 in today's inflation-adjusted terms. That peak was driven by speculative mania and cornering attempts, not by fundamental supply shortage. Today's move is fundamentally driven. Industrial demand is structurally higher than in 1980. Investment demand is globally accessible through ETFs and online dealers in ways that did not exist in 1980. Government and central bank buying is a new factor that was not present in 1980. If the current move is more fundamentally sound than the 1980 spike, then the eventual peak could be higher and more sustained. Some analysts are projecting silver to reach triple digits, $100 per ounce or more. These projections are based on supply deficit models that calculate how many years of shortage will persist before new supply or demand destruction brings the market back into balance. If the deficit continues for 3 to 5 years, and if above-ground stockpiles are depleted during that time, then price must rise to whatever level is necessary to either bring new supply online or destroy enough demand to balance the market. That level could be 100. It could be 150. It could be higher. The market will determine the clearing price through the mechanism of buyers and sellers meeting. But the direction is clear. The destination is higher. For the individual who holds physical silver, this moment is validation. The thesis that physical would decouple from paper is playing out in real time. The thesis that Eastern demand would overwhelm Western supply is confirmed. The thesis that governments would eventually panic and hoard strategic materials is being proven. The decision to buy physical silver and store it securely, the decision to ignore the mockery and the skepticism, the decision to hold through volatility and manipulation, all of that is being vindicated, not through words, through price. Shanghai is not lying. Shanghai is paying $87 because that is what silver is actually worth to someone who needs it and cannot print more. For those who ignored the warnings, for those who believed the COMEX price was real, for those who held paper contracts or unallocated accounts or ETFs that do not allow redemption, this moment is painful. They are discovering that the $75 price on their screen is meaningless if they cannot convert it into physical metal. They are discovering that their broker will offer cash settlement rather than delivery. They are discovering that their ETF is suspended or delayed. They are discovering that the fine print they never read has clauses that allow the institution to default on their obligation to deliver. They are learning the hard way that in a crisis, paper promises are worthless. The banks and institutions that are short silver are in the most dangerous position of all. They sold contracts at 60, at 65, at 70, expecting to cover at lower prices. Now they are facing losses at 75 on their COMEX books, while the physical market trades at 87. Their models did not account for a $12 spread. Their risk management systems assumed arbitrage would keep markets aligned. Their hedges were structured on the assumption that they could source physical if needed. All of those assumptions have failed. They are trapped in a position where covering their shorts will push the price higher, where maintaining their shorts will bleed them daily, and where the physical metal they need to close the position does not exist in the quantities required. This is what a short squeeze looks like at the institutional level. It is not dramatic. It is not visible on CNBC. It happens in closed-door meetings where risk officers explain to executives that the firm is facing existential losses. It happens in emergency calls to regulators asking for rule changes or bailouts. It happens in quiet negotiations where one bank tries to buy out another bank, while short position at a massive loss just to prevent an even larger loss later. The public will not see this happening until it is too late, until banks announce massive write-downs, until trading is halted, until delivery is suspended, until force majeure is declared. By then, the opportunity to position correctly will have passed. Let's address the skeptics who will say this is hype, who will say that 87 is just a temporary spike, who will say the spread will close and prices will normalize. To them, the question must be asked, what mechanism will close the spread? If arbitrage is not working, if physical cannot flow from west to east, if demand in the east is accelerating rather than slowing, then what force will bring prices back together? Hope is not a mechanism. Belief is not a mechanism. Saying that markets always correct is not a mechanism. Markets correct when supply and demand forces realign. But if supply is constrained and demand is increasing, then correction means prices going higher, not lower. The other argument will be that this is a bubble, that prices have risen too far too fast and must correct. But bubbles are characterized by speculation detached from fundamentals. Bubbles are driven by retail investors buying something they do not understand because everyone else is buying it. Bubbles are characterized by easy credit and leverage and mania. What is happening in Shanghai right now is not speculation. It is procurement. It is companies and governments buying a material they need to operate. They are not buying because they think they can flip it for profit next month. They are buying because without it, their factories stop, their products cannot be made, their strategic goals cannot be achieved. That is not a bubble. That is a shortage. The parallels to other commodity squeezes are instructive. In 2008, oil went to $147 per barrel, not because of speculation alone, but because demand from China and India was overwhelming supply growth. When the financial crisis hit, demand collapsed and oil crashed. But before the crash, the squeeze was real and the price was justified by the supply-demand imbalance. In 2021, lumber prices exploded because COVID disrupted supply chains and housing demand surged. The squeeze was real. The price eventually corrected, but only after new supply came online and demand normalized. The silver squeeze today is similar in that it is supply and demand driven. The difference is that silver supply cannot increase quickly, and demand is driven by long-term structural trends, not temporary disruptions. This means the squeeze could last longer and go higher than past examples. The geopolitical dimension cannot be ignored. Silver is now a strategic competition between East and West. The West controlled the pricing mechanism for 50 years through COMEX and the London Fix. But the East has the industrial demand and the financial resources to take control of the physical market. What we are witnessing is a transfer of pricing power from West to East. When the East decides what silver is worth and the West must pay that price or go without, the entire power dynamic of the global economy shifts. This is not just about silver. This is about resource control. This is about who determines the value of strategic materials. This is about the decline of Western financial dominance and the rise of Eastern industrial dominance. China is not trying to crash the silver market. China is trying to own the silver market. They are using their industrial demand, their state capital, their strategic planning to accumulate as much physical silver as possible before the rest of the world realizes what is happening. The $87 price in Shanghai is not a mistake. It is a message. The message is, we will pay whatever it takes to secure supply. We do not care about your paper price. We do not recognize your futures market as legitimate. We are setting the real price through physical transactions. And if you want to compete with us, you will have to pay our price. The United States government is beginning to understand this, which is why the Pentagon signed the $7.4 billion smelter deal in Tennessee. They are trying to build domestic processing capacity, so they are not dependent on China. But that smelter will not be operational until 2029. That is 3 years away. What happens during those 3 years? The drain accelerates, the competition intensifies, and every ounce of silver that flows to China is an ounce that will not be available to the United States when they need it for their own strategic purposes. The irony is that the United States had decades to prepare for this. They had decades to maintain strategic stockpiles. They had decades to support domestic mining and refining. They chose not to. They chose to let the free market handle it. They chose to believe that global supply chains would always be available. They chose to believe that financial engineering could replace physical possession. And now they are paying the price. Literally, they are paying $87 in the physical market for a metal their own futures exchange says is worth $75. The arbitrage gap is the cost of their denial. For the retail silver holder, the question now is what to do. Should you sell at 87? Should you hold for higher prices? Should you buy more? The answer depends on your time horizon and your conviction. If you believe the squeeze is over and 87 is the top, then selling makes sense. But if you believe the squeeze is just beginning, if you believe $100 or higher is coming, if you believe the paper market will eventually fail completely and physical will trade at even larger premiums, then holding or even adding makes sense. The risk of selling too early is that you lock in profit but miss the larger move. The risk of holding too long is that you ride it back down if the market corrects sharply. The middle path is to take some profit while holding core positions. If you bought silver at $30 per ounce, you could sell 25% of your position at 87 lock-in massive gains and hold the remaining 75% for higher prices. This allows you to realize profit while maintaining exposure to upside. If the market goes to 100, you still benefit. If the market corrects to 70, you already took profit at 87. This strategy reduces regret regardless of outcome. What should not be done is panic selling into weakness if there is a short-term correction. If Shanghai pulls back from 87 to 82 next week because of profit taking or a temporary lull in demand, that is not a reason to abandon the position. That is a reason to add if you have capital available. The structural shortage has not disappeared. The industrial demand has not disappeared. The government buying has not disappeared. The geopolitical competition has not disappeared. A $5 pullback does not change the thesis. It is just noise. The signal is the $12 gap. The signal is the vertical panic buying. The signal is the fact that physical silver in Asia is trading at unprecedented premiums. That signal is loud and clear. The system is breaking. The final point is about preparation versus prediction. Nobody can predict the exact top. Nobody knows if 87 is halfway to the peak or close to it. Nobody knows when the correction will come or how deep it will be. But preparation does not require prediction. Preparation requires understanding the structure of the market, recognizing the risks, and positioning accordingly. If you hold physical silver, you are prepared for a scenario where paper fails, and physical is the only form of wealth that matters. If you hold nothing, you're betting that the current system remains stable indefinitely. That bet is looking increasingly dangerous. Shanghai hit $87 today. The panic buying has gone vertical. The spread between East and West has shattered all historical norms. The institutions that built the suppression scheme are trapped in their own positions. The governments that ignored strategic planning are now scrambling to catch up. And the individuals who understood physical possession long before it became obvious are watching their thesis play out in real time. The question is no longer if the system breaks. The question is, how much higher does price go before it does? And when the break comes, will you be holding paper or metal? One will be worth $87 and climbing. The other will be worth whatever the fine print says your broker owes you, which is usually far less than you thought.